Well, apparently there's about 100% chance that my gears are going to get grinded. Yes, an economic recession is on its way. Layoffs everywhere. Bloomberg reported that the forecast for a U.S. recession within the year hit 100%. Oh no, brace yourself. The recession is coming. Now, if you've been following me on Twitter or following this channel, this is something that we've been talking about for quite some time. So it should not be new news. It was quite obvious, right? We talked about this back in, I don't know, June, and I'll tell more why in June it was important. But this is the most anticipated recession, maybe coming soon. Might as well get your house in order. What does that mean? It means pay off consumer debt, right? Credit card rates are going up. Save an emergency fund, cut unnecessary expenses, try to increase your income, and whatever else you can possibly do to protect your house. Now, back in June, what was taking place on the 10-year, 2-year yield curve, and I'll tell you why that's important here momentarily. But back in June, you can see we were heading into inversion. That red line marks right here where this 0 marker is, right? That is where it inverted. Okay, and since that point, we've gotten even deeper inversion down to minus 50 basis points. Now what we're starting to see is this curve, the 10-year and 3-month Fed staple is now at 5 basis points. We've been saying it's flat as a pancake. Well, look at this thing start to head down south even further. You can see here on the Treasury website that the 3-month, right, it'll have the dates up here. Or sorry, not the dates. It'll have the term, so 1 month, 2 month, 3 month, 6 month, and so forth. In the middle of the screen here are all the yields and the dates that they've changed. So on October today, right, October 17th, the 3-month is at 3.97%. Okay, and then the 10-year is at 4.02. There is a 5 basis point difference there, and almost the 3-month is over the 10-year. Why would anybody, invest in, longer term bonds right here, 10-year yields, when the 3-month, when you can hold the 3-month for just about the same exact rate, okay? This is not good. If we take a look at the TNX, you can see the 10-year yield. This is what that's tracking on a weekly basis. It's been heading straight up. What does that affect? Well, it affects relative strength of multiple sectors, and that includes XLK relative to SPY and XLY relative to SPY. As this went up, what happened here? These lines have been going down, and not only that, they've been going down for quite some time, okay? As the yields rise, that puts pressure on these heavy growth sectors that are just loaded to the nines with debt. Okay, now what else is important about that? The 3-month right here coming in potentially over the 10-year, creating an inversion. Well, it's a great predictor of recessions. And as you can see, this 0 line, this right here, if it gets below it, it's an inversion. Now we're looking back to the late 80s over here, and you can see it's been inverted right here. It's inverted over here deeply. It's inverted here deeply. It's even inverted here going into 2020 deeply. And now we are not too far off from being inverted again. Now, as you can see, the gray shaded areas, those are marking recessions, okay? So we had a recession here, we had a recession here, we had a recession here, we had a recession here. That all happened very shortly after of being inverted, okay? So as Bloomberg's reporting it, it's quite obvious. We've seen this being taking place. What does that mean for the markets? Well, remember, the Fed is tightening into a slowdown. This is just to give you an overall view, right? What we're doing here is giving you just an overall picture because, trust me, the market looks like it's ready to fly right now too. But as the Fed is tightening its balance sheet into a slowdown, liquidity is moving out, volatility is increasing, right? Volatility is just throwing the market back and forth. But if you want to be more specific on what I mean by volatility, just take a look at the volatility index. This right here is the VIX. The VIX, even despite today's big day, closed at 31.37%. Okay, we are still in the 30s here, which means we can see over 2% swings on a daily basis until this comes down in the S&P 500. And that by no means is normal market behavior. This is where people get thrown. This is, like I've said many times, this is where fortunes are made and fortunes are lost. Okay, VXN, NASDAQ volatility is at 3707. Good luck with that. RVX, Russell volatility is 3581. Good luck with that. And on top of all of that, the dollar is still within an uptrend, higher highs and higher lows. When this is in an uptrend, look what's in the downtrend. The S&P 500, lower highs and lower lows. The dollar, right again, is higher highs and higher lows. I get those confused. If you take a look at the economic cycle, where do we fall within the economic cycle? In my opinion, we're still here, which is stage 6. Stage 6 means bonds are down, stocks down, commodities down. All right. Now, commodities, some of them are starting to catch a bid, so we'll see here if anything shifts. But stage 6 marks the deterioration in the economy as the business cycle prepares to move from an expansion phase to a contraction phase. This is nothing new. We've been sharing this. And this, as we start to move into stage 1, because that would be going into stage 1, we'd have to see bonds start to rally. And as we've already seen, bonds have been getting smashed, including today, right? Bonds were heading down. Meanwhile, what was very interesting today in the intraday timeframes, the Qs started moving up, and that is very concerning or disconcerting, right? You want to be very paying close attention to that type of price action. And if we take a look at the 15-minute time frame, what happened today, right? We saw a huge move in the S&P 500. It was up 2.57%, but the bulk of that came from the overnight trading session and the pre-market trading session, right? We gapped way up, and pretty much all day we just kind of rallied in place. We went up a little bit, we came back down. So the price action in the cash markets didn't do anything. We still remain in this complete and utter crazy chop box that continues to build open interest that can create a wild swing when we start getting outside of it, right? We've gotten outside of it over here, we've gotten outside of it down here, but when we have a decisive break, that's when we can see things become quite violent in these markets, even more so than we're currently seeing right here. Now we are currently on the 15-minute time frame. We are flagging right here. We have we're above the 5-day moving average. It's rather neutral. So if we start breaking up through this, we have the weekly expected move just above 370. And don't ever rule it out that we can't go higher than that, right? 380 might be a key level to watch, right? That is right by this prior swing high right over here. So that is something that we'll continue to pay attention to. It looks like the futures market right now is currently catching a bid. We'll see if that's sustained come morning time. If we take a look at the Qs, very same situation. Huge gap up. It was up 3.3% on the day. And what did we do all day in the cash market? We didn't do anything. And where are we in the last month of trading, right? We're nowhere, right? We're back to where we were right into this range. We're right at that weekly expected move. Yeah, can we start gapping up further? Yeah, absolutely. But every time we've seen very strong moves, they're followed up with some pretty brutal price action too as well. And we'll get into the signal charts momentarily. Same thing goes with the IWM. We're completely in this chop box over here. Open interest continues to build just within this wild trading range. We gapped way up, flagged, and we're just sitting right below that weekly expected move there too as well. This is a time to be very careful, which I'll conclude here towards the end of the show. We still got quite a bit to go, but yeah, 11 sectors in the S&P 500, all up on the day. This to me represents just obviously a short covering, a bid to cover, whatever you want to call it. When the correlation is this high, everything is up. It just seems to me like it's mostly a short covering, and you can see that within like the volume profile and just how price action, how violent of a move it was. Okay, so what you need to see is actual real buyers start to step in and get excited to perpetuate a move higher, right? We need to see follow through. Now, if we take a look at some of these charts, I'm going to expand this a little bit bigger here, sorry. If we take a look at the big mega cap stocks, I want to just point out something interesting that I noticed today within really the first hour of trading almost, but we're closing not too far off that upper weekly expected move on day one. So we have a little bit more left in Apple to go. Amazon, we closed above it on day one. Okay, so that's something to be paying attention to. Microsoft tagged it and started selling subtly off. So yeah, we are once again tagging the the weekly expected move on day one, which is absolutely incredible. And I'll tell you why here momentarily too. Google tagged it, started selling off from that point. We'll see if it can continue to hold or if we're going to start breaking those levels. Meta also closed right there on that upper weekly expected move there too on day one. And then Netflix is not too far off. Now Netflix is interesting because Netflix's implied volatility is still through the roof because they have earnings coming up. It's still expecting by the week's end, and we'll redo this when we come closer to as well for Tesla. $30 expected move, which can take us to around 260 actually, which is these were the weekly expected moves right? But it's pricing in implied volatility, is pricing in, it's trying to handicap what the risk is for the remainder of the week, and it's still looking at a plus or minus $30 move in Netflix. So yeah, get ready for some wild volatility continuance. And Tesla still looking at a $20 expected move even after today's move. So a lot of volatility is packed into these markets. We just had an inside trading day on Tesla, right? It was a big, CPI report. We gapped down, we ripped up higher. We gapped up, bearish engulfing. Today was an inside trading day, right? This is, we're not going anywhere, but people are getting very excited by the big, large swings as it stands right now. So you got to be careful. If we start getting above, obviously, this prior high on this large bearish engulfing, that can open the door for a little bit more of a rally. But we'll see here where it wants to take us. Me personally, my thought is, I'm not gonna just take a wild, risky chance of going long or short Tesla into earnings. And same with Netflix. I'll trade it intraday when the trade's set up. But as it stands right now, this is too much volatility. And when there's too much volatility, you need to reduce your position sizes greatly because there's just a lot of risk. Now, if we take a look at the summation index, we're still not crossed over the parabolic SAR. So I'm waiting for that to happen. And it looks like it can start doing it here soon. So we'll see if we get that crossover, which could indicate a potential change in trend. Could be short term, could be longer term, but we've seen like this prior one over here, it started the trend for this big move down, and this one right here started the trend for this nice move up. So we'll see if we do get that here momentarily. Now, the NASDAQ summation index, the NASI, right? This one is starting to curl back over. It still hasn't crossed it. And another good note here is that we have a bullish divergence on the NASDAQ McClellan oscillator. We have this pointing up, higher lows, and we have this making lower lows, which tells us like, okay, the internals, so the price action is heading lower, but the internals are strengthening up here, and this is about to cross over. So this might indicate that we might see the NASDAQ gear up for a potential rally. Now, if we take a look at this right here, I like to use this as an indicator to potentially tell us that volatility may be around the corner. We officially got that signal right here, crossed above that 1.3 rate of change. So it's telling us, hey, at least on the last 10, 11 signals, it worked. That volatility could be around the corner. Okay, so we saw this signal right here. This is the green. Volatility started going down. The last volatility signal for the warning shot that volatility could go higher was right here. It came down a little bit, and then we popped obviously a lot higher. It doesn't tell you how high it's going to go by any means, but it is something to just worth paying attention to. If we take a look at SPX over TLT, this ratio right over here on the upper box, and then we have just the S&P 500 below us. You can see here we're still building out that divergence that we talked about earlier, right? We have a high to a lower high, and then we have a high to a higher high. And the last times that's happened, I've highlighted here in these boxes. Bam, the S&P 500 started heading down right here. S&P 500 down, 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 and it even was on this pink line where it started right here, down there too as well. So is it going to play out? It's something to just be aware of, cautious of, and I'll kind of explain kind of my thought process there momentarily. But let's take a look at the Pring Bottom Fisher. This one did cross over a while ago here, and we're starting to see the market move up. So good stuff there. And then the buy and sell signal. This hasn't updated today. It's still from October 14th, but I should get these numbers a little bit later. If you're in the Patreon group, I give you access to all my stock market charts. So if you want my stock market charts, you can join the Patreon group, and I'll have a little section there. But I also give some trade ideas. I give all kinds of, just random stuff. Yeah, go to the Patreon, link is in the description if you want to check that out. But this looks like it's about to cross over, so we'll see here if we get that crossover, which indicates a buy signal, and typically we get some nice rallies from that. So this year, these are some of the buy signals. It came down a little bit more, but we rallied. A couple of them were just like extra 4 days of rallying, but still worth paying attention to there. And then we have the BPCOMPQ, the NASDAQ Bullish Percent Index. Nice positive divergence right here, right? We have a low to a lower low, a high to a higher low, a low to a higher low right there as well. So that right there could be an indication that we should be getting some sort of a potential rally. It's always possible in the NASDAQ composite going into potentially the remainder of this week or even heading into the earnings, right? There's a lot of curveballs. Here's my thought process, okay? Actually, I'm gonna share this first, and then I'll give you my thought process. So here's the lows for the week and the high for the week. I didn't share them because I didn't make a weekly recap, but if you want to screenshot this, here's the S&P 500, here's the SPY, Qs, and IWM. These are the weekly risk ranges. This, once again, is the higher level. This right here is the lower level, okay? So if you want to screenshot that so you can mark them on your screen, please be my guest. All right, so my thought process here for the remainder of the week, there's a lot of diverging signals, meaning that there are some that are bullish, that could be said that are very bullish, but there's some that still remain bearish. And that makes sense to an extent, right? Not everything always lines up, but it makes sense because when I look at the price action chart, things have been getting oversold and it seems like it could be ready for some sort of a bounce. How high can that bounce potentially go? Well, it's very hard to determine how high the bounce could potentially go. But if we were to mark out some key levels, as we previously stated on the S&P 500 chart, right? Because we're in this chop box, I would say just pay attention up into this range right over here, 378 to 380. Because if this flag right here were to break out, that can potentially take us up to there, even despite it being cracking through this 370 level. Remember, these things, we have some violent sell-offs. So how do you position yourself when we've seen violent rallies and violent sell-offs? And by the way, just look at the last 3 days of trading. We gapped way down, bearish. We rallied all the way up, bullish. The next day, we just completely crushed half of that move, bearish. And then we didn't have any chance to get in because it didn't set itself up during the cash market. So you'd have to have traded futures or whatever the case may be. All right, so we gapped up and then we didn't do anything. There is nothing here to stop this from coming right back down to the lower range, and there's nothing to stop this to potentially break out back up here to 380. So how I'm looking at it is very tactically, right? If we start coming up into these ranges, I think that the trend's going to continue. So we'll start looking to see how it sets up there. And if we start breaking down here, well, then I'll start to look for potential back to, potential rally setups. As it stands right now, the 5-day moving average isn't giving us a clear direction. So if you want to just step back and sit on your hands, right, or tactically play this from an intraday perspective because volatility allows for that right now, do so. But I would not be gambling in this market because it is by far the most dangerous we've seen pretty much all year, given the context of this current chart that we are looking at. That's all I got for you on today's episode, everybody. Hope it helped out. See ya.